Today I want to talk to you guys about the impossible. Making a 7% return or greater every single year. Hey everybody, welcome back to Drawbridge Finance. My name is Levi Woods and I am not a financial advisor. This is an opinion channel about money. And one of the questions I get asked a lot on my channel is, how do I make a 7% return? In fact, most people scoff at it. They don't think that a 7% return is achievable. And I'm going to show you today two of the American indexes that go up and up and up every single year, and how we can capitalize on those by buying ETFs that match those particular indexes. So the first one we want to talk about is SPY, S-P-Y. The second one we're going to talk about is the NASDAQ ETF, QQQ. One of the things people talk about a lot on my channel is risk. And of course, there's going to be down years in any market. So we have to look at data that backtests past our last major correction, which was in 2007 and 2008. So I'm going to go back in this test and we're going to look at 11 years worth of data. Let's look at the chart. In this column, we can see the closing price for each of the quarters during the year. If I scroll down, we can see right up to the price $273.92, which is the price it would cost you to purchase it on January 1st, 2018. You could have purchased this ETF for $143.75, January 1st, 2007. You can see that it's gone up dollar amount, but how much did it go up annually? I'm going to add a column that shows the annual percentage return. Let's look at the calculation. From January 1st, 2007 to January 1st, 2008, went from $143 to $137, which gives us a simple annual return of negative 4%, and that's calculated over the year. So likewise, in 2008, went from $137 down to $82, showing a 39% return. Now this is annual simple rate of return. Now in 2009, we had a 29%, from 82 to 107. So what's interesting about this, if we scroll down through the years, I've highlighted the boxes in green that show double a 7% return. Almost always it returns better than 7%. So this whole chart would be green. So we continue to scroll down and you can see that last year we had a 20% return. 20% return is an average return for a bull market. You can see 17%, 19%, 19%, 29%. These are common returns in a bull market. But that's not all of it. That's not all the money you would have made had you invested in this ETF. It also pays a dividend. So we have to calculate that into this account. This ETF paid out 4 dividends in 2007, totaling $2.70, which is a yield of 1.85% based on the average price taken from July 2007. I just had to base it on some number in the chart. If we take the annual return of negative 4%, we add the 1.85% dividend income, and we get a total return of investment of negative 2% for the year. So now we can scroll down. This is really the important column, is total return on investment. 2009, 31% return. 2010, 21% return. January 2011, 4% return. So you could see that over time, the annual average on the SPY was 8.23%. That is not inclusive of the dividend. Once we add in that dividend, which averages out to 2% a year, we get this 10.23%, inclusive of the last major crash. Now, I don't want to bore you guys. I'm just going to add the QQQ really quickly. So let's just quickly go over that. Looking for the green highlights, we have some massive years. The biggest thing, inclusive of the dividend, 2009, 50% return, 33% return, 30% return, 18% return. Over the last 11 years, this has returned an average of 26% per year. One ETF. Instant diversification, single transaction, buy and hold investing. Now, to take this one step further, I thought, well, you know what? You can't just assume that everybody's going to buy January 1st of 2007 prior to the crash and see what the return is. So I decided to build a giant chart that shows all of the times when we make this 7% or greater. The first thing we're going to look at is this is the ETF SPY. What we're showing here is simple annual returns. On January 1st, 2007, the purchase price would have been $143.75. If you sold it April 1st, 2007 for $148, you would have made a couple dollars, and to do the calculation, we would have found out that the simple annual return was 12.6% based on you holding it for that 3-month period. Each of these corresponds that way. So if we look at July 1st, 2008, purchase price of $126.83. If you sold it for $96.83 on October 1st, 2008, it would work out, it's only about a 23% loss total from 126 to 96. But annualized, because you've only held it for 3 months, it would work out to a negative of 94%, which means that this chart kind of, any of these purchases, this very first transaction, when you've only held it for 3 months, it's not showing you very much data. Like this would be 3 month, 6 month, 9 month. After a year or about 4 sells down is when you really start to see what an actual average is. It's hard to project an average off of only a 3-month term. So really you shouldn't use these top kind of rows of each column. This gives us a great visual representation for how easy it is to make money. So anything in green is above our 7% target. For example, if we purchased April 1st, 2009, $87 and sold July 1st, 2011, we would have made an average annual return of 21.3%. Let's look a little bit further out on this chart and you can just see how much green is on here. Kind of unreal, but if you had purchased January 1st, 2007 and held until January 1st, 2018, you'd make an average of 8.2%. Now this chart is based only on the ETF price. It doesn't actually include the dividend, so you'd have to add another 2% for the SPY for that dividend that it pays. So this 8.2 would actually be 10.2%. Well, what if you purchased later? What if we didn't start investing until July 1st of 2009? Would have purchased at $98. Today it would have been worth $273. Average rate of return, 20.8%. Plus the 2% dividend that you would have gotten would have been 22.8%. Even if you had purchased just before the crash in 2007, these are like the worst, these columns here are the worst time to invest. Had you held it, you would have been making average returns well over our 7% threshold. Any investments done in the last 7 years, if we look back at 2010, would currently be averaging 19%, 18%, 16%. These are per year. 14%, 17, 18, 18, 16, 18. Doesn't even matter when you buy when we're in a bull market. It's going up, the stuff's going up. Of course, you're going to have a correction at some point. It's going to happen. But over time, these averages work out. Hopefully that shows you guys a little bit. Let's just look at the NASDAQ one. Let's look at the overall. You can see that purchases going back to January 2007, 24% per year, 23%, 23, 19, 26, 25, 27, 42, 51, 42. I mean, if you're buying right after the crash, in January of 2009, when the panic was over, you would have a 51% return plus the dividend per year, 51% return. These are diversified, they pay a dividend, and they return a huge percentage every single year. So for those of you out there that think that this is difficult to make a 7% return every single year, you are incorrect. That's how easy it is. 2 ETFs, SPY, QQQ. Thanks so much. Let's get rich together.